Hi, good evening, friends. Today we'll discuss the supplier financing arrangement, the impact in IAS 7 and IFRS 7. Before we start, would request you all to please subscribe to the channel Accounts and Taxation Ka Gyan. So the link of this channel is given in this current slide. Please subscribe to the channel. It will boost our morale. What is the supplier financing arrangement? The supplier financing arrangement is an arrangement where the buyer has to make a payment to the supplier and bank makes an early payment to the supplier, and buyer in turns uh, gets extended credit terms from the bank. So to give an example, the buyer had to make a payment to on 31st December to the supplier. The banks makes the payment to the supplier on 30th of November, and buyer makes the payment to the bank on 31st of March. So he gets extended credit terms. So this is the effect of supplier financing arrangement. Definition: the arrangement provides the supplier with the early payment terms compared to the payment due dates of the invoices. So the arrangement provides supplier with the early payment terms. The arrangement provides the buyer with the extended credit terms compared to the payment due date of the invoices. So payment provides extended credit terms to the buyer. Impact: impact of this arrangement would be that the liability in the buyer's books gets liquidated as the bank has made payment to the supplier. So the trade creditors should ideally be replaced by a working capital loan, and the debtors in the books of the supplier should get liquidated on receiving the payment from the bank. Another aspect of this arrangement, the another aspect of the supplier financing arrangement could be that bank acts as a payer for the creditors of the buyer on the due dates. So it acts as an payer of the creditors of the buyer on the due dates. This is one of the another aspect of the arrangement. The supplier financing arrangement could be called reverse factoring or supply chain finance. Reason for amendment in IAS 7 and IFRS 7: the investors wanted more transparency in the supplier financing arrangement. How the supplier financing arrangement affect the liquidity risk, cash flows and financial liabilities, the investors wanted to know. So this was the reason for amendment in IAS 7 and IFRS 7. Additional disclosures. IAS 7 and IFRS 7 has come out with additional disclosures in supplier financing scheme. How the SFS has affected the liabilities and the cash flow, effect of these arrangements on liquidity risk, and how these arrangements would be affected if these arrangements were no longer available. If these arrangements were no longer available to the buyer, how it will affect the liquidity risk of the buyer. This has to be given as additional disclosure in the SFS. The effective date is 1st January 24. However, transition relief is there. The opening balances, as the details would not be available, so opening balances figures need not be given, and the interim periods, the quarterly financial reporting of figures need not be given. The balance at the as on 31st of December needs to be given. These amendments would also flow in Ind-AS, and most likely the due date for implementing these in Ind-AS would be 1st of April 2024. In scope and out of scope, a financial provider to pay the supplier of a buyer entity, and the buyer agrees to pay the same date at or a later date is in scope. A financier provides to pay the supplier of a buyer entity, and the buyer agrees to pay at the same date or later date is in scope. All other working capital arrangements are out of scope. Example: receivables financing, LC, credit card used for payment, or inventory financing. These are out of scope of this arrangement. Disclosure in IAS 7. Terms and conditions in supplier financing arrangement. Terms and conditions, if they are dissimilar, needs to be disclosed. The group example is the group participates in SFS. Under the arrangement, a bank agrees to pay amounts to the participating supplier in respect of the invoices owed by the group and receives settlement from the group at a later date. The principal purpose of this arrangement is to facilitate efficient payment processing and enable the willing suppliers to receive the payment from the bank before the invoice due date. The dissimilar disclosures is type A of SFS and type B of SFS. The carrying amount of the liabilities under the SFS and the amount paid by the bank to the suppliers. The carrying amount of the liabilities is to be disclosed and the amount paid by the bank to the suppliers needs to be disclosed. So example, if the total creditors are 100, 1000 and supplier financing scheme is for 200, then these 1000 and 200 needs to be disclosed, and out of this 200 how much is paid by the bank to the supplier, that if that figure is 100, this figure would be available with the bank, and from the bank it would have to be fetched and that figure would have to be disclosed. So this disclosure is required uh, in the financial statements. Uh, Range of the payment due dates. Range of the payment due dates of the financial liability. Both for the SFS and the normal creditors, the range of the financial liability is to be given. Example, 80 to 90 days is the after the due date is the range for the payment of the supplier financing arrangement, and 60 to 70 days is the range for the payment of the other creditors. That range needs to be given. If the range between the two is wide, then additional disclosure needs to be given. Then effects of non-cash changes on the financial liability. Example, in case of acquisition, if supplier financing arrangement has been if a company has been acquired and it has supplier financing arrangement, then non-cash changes in the financial liability needs to be given. In case the liability is in foreign currency, if the liability of the trade creditors is in foreign currency and it will be subject to exchange rate, this non-cash change also needs to be given in the financial statements. So this is the disclosure required in IAS 7. In IFRS 7, the liquidity risk information needs to be given. Impact of withdrawal of the credit facility on the organization, this needs to be given. This can be explained by an example. The entity participates in SFS with the principal purpose of facilitating efficient payment of invoices to the supplier. This allows to centralize the payments of trade payables. The SFS does not significantly extend the payment terms beyond the normal terms agreed with the supplier and that are not participating, and the program assists in making cash outflows more predictable. So this is an example of disclosure in IFRS 7. This brings us to the end of the session. Please do subscribe, like and share the video. Please subscribe to the channel. This will boost our morale. Thank you so much.